Good afternoon, everyone, and thank you all for joining for another self-directed IRA Saturday. Today we have Thomas Stallard here to talk about senior housing, and so we're going to have a really wonderful presentation for you on that. Before we hop into it, we're going to have just a few quick announcements, and then we'll pass it off to our wonderful speaker to take it away for us. But just first and foremost, for these educational webinars that we do, it's important to note that we do not provide any type of tax, legal, or investment structuring advice. And should that be the type of information or counsel that you seek, it's important that you do go and contact those individuals in your network to get that type of information. But from here today, we are going to just briefly talk about some of the free consultations that Quest offers. If you are one of those individuals who may be either looking to use your own IRA, or if you have other investors that you know of who have IRAs that may be able to fund into your deals, we do offer these free consultations to go through with you so we can talk to you a little bit about what the logistics of having an IRA looks like, some of the costs associated, and also some of the restrictions, because that's just as important as what you can invest into is what you can't. And so this is a free service that Quest offers in order for you to really paint out your full financial future. Now, with that being said, for those of you who are already clients with Quest, we do offer a Gold Family service. These are for those active investors. Maybe if you have a lot of individuals in your family, yourself, your spouse, your children, maybe your parents, who are all going to be investing through their IRA or some type of qualified plan, this is an all-encompassing service that we have that will just have one annual fee between all of the accounts that you'll be able to be invited out to exclusive dinners. You'll have special account reminders for your family in particular, and you also have expedited processing through our Gold Family. So certainly something to consider once you do start becoming more active with your investing. Now, we do have a social that we are hosting. This is just like usual going to be hosted in person in Houston, Austin, and Dallas. Houston is going to be November 7th, Austin November 9th, and Dallas is November 14th. We've had Megan put the link in the chat if you are interested in registering. This is going to be a really cool event. We have a panel for both all short-term, midterm, and long-term rentals. So these are experts in these individual asset classes who've come to talk about what they look like currently, what the current market is, how you can get involved in investing in them. And then, of course, they're going to be there to answer any questions that you may have about these particular assets. So this is going to be a really great event. I highly encourage you to attend. It will also be streamed online. So for those of you who are either not in Texas or can't make it, we will have that available to you through our YouTube page as well. And just a couple more events before we close out. We are bringing back our QuestCon live event. This is an annual event that Quest hosts every year. It is completely online. It is free to register. This is a event that we are focusing on women and alternative investing. So we've got a great lineup of all women speakers who are going to come and again talk about their specific asset classes, the experience they've had in that industry, and what the market is going to look like here within the next year. We are here closing out 2023, so we're going to have a lot of really interesting perspectives as to what 2024 is going to look like for everyone in the alternative investing industry. This is an all-day event, so 9 a.m. to 4 p.m. Central Time, and it's going to be taking place on November 17th. Again, we'll link in the chat where you can register today. And last but certainly not least, for those of you familiar with Quest, you may be familiar with our Quest Expo. This is a large event that we host. This one's going to take place in Irving, Texas. This is an in-person event. It's going to be 2 days, and it's a full lineup of speakers throughout, or apologies, 3 days. So full lineup of speakers throughout these 3 days. And again, the focus is on alternative investing. And so you're going to see things like cryptocurrency, oil and gas, of course, real estate, multifamily syndications, private lending, anything typically not publicly traded. You will have some form of expert here at this event talking to you about how you can get involved, answering your questions, and really providing a wealth of information and knowledge on what that asset class is going to look like for you in the future. So highly encourage you to check us out there. All of the links are in the chat for you to register. But with that being said, I'm going to go ahead and wrap this up on my end so I can pass the mic over to Mr. Stallard. As always, please do put your questions in the chat. He is going to go ahead and take it over for us, and he will be able to answer all of your questions at the end. So all yours, Mr. Stallard.
Okay, thanks, Brianna. I'd like to say thanks to Quest, for inviting me to speak today. I'm going to try to keep this as informative as I possibly can. I'm not a professional speaker, so I'll talk to you as I would my brother. So it'll be fairly conversational. I'll give you a good background, but then get into the specifics and the meat of investing in this asset class and what we have learned along the way. So I'm going to start my PowerPoint here. Okay, hopefully everybody can see that. The silver lining to senior housing. So senior housing this was not what we started out to do as a company. I'll give you the background of our company in just a second, but it was something that we fell into, and through a lot of unique circumstances, we recognized this is a pretty unique opportunity. I think right now the timing for this type of investment is crucial and key, and you'll see, and it's mostly demographic driven. Our company, Black Ink Development Holdings, we are a commercial real estate development holding company. We started this company in 2017. We've had a very quick growth. We've developed or purchased over 300 million in commercial real estate assets. It's the Black Ink is kind of a funny name. We have nothing to do with ink. It's obviously an accounting term. So Black Ink is a lot better than red ink when you look at the balance sheet. So that's kind of the clever name that we came up with. So we like profit. The company is a partnership with, there's two individuals, myself and Ernest Cunningham. And I'll give you our backgrounds very quickly. Ernest Cunningham is an entrepreneur, real estate investor, technology CEO. He's primarily, if you talk to Ernest, he would tell you his day job is CEO. His first company, One Source Networks, he started back in 2007 as a telecom technology company. Grew from zero revenue to 100 million in recurring revenue in 8 years. Was an Inc. top 10 fastest growing company. In 2015, he sold that company to a company called GTT for $186 million. If that was me, I would have ridden off into the sunset, but that was not him. So he said he tried to retire for 60 miserable days and said couldn't do it. So he bought another company called Global Gig out of London, which I just realized I misspelled Global Gig, but oh, no, I didn't. Anyway, so Global Gig is in London. It's now based in San Antonio, Texas, has offices in Paris, Casablanca, Morocco, Costa Rica, kind of all over, growing that company very quickly. However, his passion and probably biggest hobby is real estate. He's owned, like most of you or a lot of you on the phone today, a lot of single family home rentals is where he got started in terms of real estate. He did flip a big portfolio of those about 15 years ago and started buying commercial real estate. When he and I started in business together in 2017, he had 14 commercial properties that were either office buildings, medical buildings, data centers, and warehouses. Very opportunistic the way he looks at real estate. My background's a little different. We've known each other for 25 years. But we had separate paths. I was in the financial services company. I worked for a small boutique broker dealer. I started as a broker, became the managing principal of the firm. Was there for 15 years. Involved in over 150 different private placement raises, about $500 million. Mostly oil and gas related, a lot of infrastructure, pipelines, saltwater disposal wells, and all that kind of stuff. At one point, like most of you, I talked to my accountant and was complaining about how much taxes I was paying and what could I do to offset that. And he said, really, the only thing you could probably do is real estate. And as I knew my buddy Ernest did a lot of real estate, he mentored me into it. And I started buying single family homes, mostly through HUD foreclosure auctions. Really liked it. It's a great asset class, was building up a nice big portfolio of those. Liked it a lot. And then one day he gave me that fateful call of, hey, let's go join and form our own company. And the idea is when we formed this company is to, again, develop commercial real estate, but then also to purchase and be opportunistic about it. But what we were really focused on is looking for a model that was somewhat predictable, but also repeatable. And when I say repeatable, I mean, if you think about like a CVS or a Walgreens, I mean, they're on every single corner. They all look exactly the same. So that's a little boring, but it's very predictable. And that's what we were looking for. So what we did is we partnered first with a company called Alamo Drafthouse. And it wasn't with the corporation, it was with a franchisee who had just taken over the Arizona or got the rights to Arizona to develop. We built our first Alamo Draft House in Tempe, Arizona. Right after that, we started building one in Gilbert, Arizona. And we were just set to build 3 more in Atlanta, Greenville, North Carolina, and Charlotte. We're going to all start them all at once. And but the pandemic hit. And when the pandemic hit, obviously that changed our minds on movie theaters because the government shut them all down. And so it's been and then of course Hollywood didn't have a lot of products, so that asset class is to recover has been somewhat difficult. However, I can happy to say this summer with Barbie and whatever other movies, it is nicely recovering. Plus the market shrunk quite a bit. We did actually, even though we're both own parts of franchise groups of Alamo Draft House, we did separate from Alamo in terms of a franchisee and become our own brand, which is called Majestic. That's what the little crown there is, Majestic Neighborhood Cinema Grills. So we own and operate. So we have the real estate, but also the operations company. Along the way, we were introduced to a company called Sodalis Senior Living. They're based out of New Braunfels, Texas, and that's really going to be the key to this talk today. The Sodalis, we went in as a commercial real estate developer. They wanted to build and expand their business, but they wanted to put some wealth behind their business with some buildings. So they were a company that had been around for 20 years. They had a really good reputation, great care, small buildings, 16 units to maybe 32. They had just finished their biggest building, which was 61 units. And so they had about 310 units of assisted living and memory care. We looked at it and we said, okay, we see opportunity here. Both of us had experience with our own parents going into assisted living. So we understood the asset class, but we didn't really realize how much we had to learn, but we learned a lot very quickly. So when we hired a JLL to do a market study of the state of Texas, and we said, find us the 3 most underserved, affluent middle markets that would fit a private pay, high-end assisted living memory care asset class. And they came back with 3 locations, and we went out and we bought land in all 3 locations to develop. When we started our first project in College Station, Texas, here's the part where we really got sold on it. To build the first building was about $16.5 million, 94 units. To fill it, to get it stabilized and all that, we projected it was going to take another $1.5 million. So to build it, fill it, furnish it, all that stuff. Well, as most of you know, when you do a construction loan, when you close on your loan, the bank hands you an appraisal that they hire some third party. When I got the appraisal, it said that the building finished empty was going to be worth $25 million. When it was full and stabilized, it would be worth $31.6 million. And as a real estate guy, I know that if you spend $18 million and you get back $25 or $30 million, that works. That's a good model. That's a model you want to repeat. When we saw that, we did, it was one of those, it was stunning to see. And so we really started just doing a deep dive on the industry. And we found out that, yes, those numbers are true. Those returns are good. But it was a little more nuanced than that. We started understanding what really affects the price, because the price does swing quite a bit. And what we realized very quickly is how much operations, your tenant, how much they affect the value of the building. And we took a really good hard look at this company that we were with, because when we built our 3 buildings, or when we were going to build 3 buildings, it was more than double the size of the company. And so we looked at that and we thought, well, we better think about this, because is this the management group that's really going to get us there to ultimately get the return that we were looking for, along with our investors in the buildings that we were looking for? And the determination was maybe. However, we wanted a little bit more control than maybe. So we purchased 90% of the company. We changed out the management from ground up. So now we owned the company. We started a competing company, or not a competing company, complementary company called Caraday Healthcare, which is a skilled nursing business. So skilled nursing is, more like a little hospital. Either people come there out of the hospital for rehab, say after heart surgery, and they're there for a short period of time, or knee replacement or hip replacement, or they're there for long-term care or hospice for end-of-life care. But either way, a lot of that, we're either taking people from assisted living memory care are going to go to skilled nursing ultimately, or people coming out of skilled nursing might go to assisted living. So one kind of complemented the other. And then along the way, we started a home health care company, and currently we're working on a pharmacy. So we looked at senior housing and senior care as really a big opportunity, and from a real estate point of view, but then also from an operations point of view. So now here we are in 2019, we finished the purchase of Sodalis. Again, at that time, they had 10 small buildings, 310 units. We exited most of the small buildings because our feeling was that a 16 bed or a 32 bed unit, the break even there, the margins are so tight. When you lose a couple residents, a couple people die, or they go to memory care, or they go off to skilled nursing, whatever it is, if you don't stay 100% full, it really affects your margins. So we kind of found a sweet spot of that 80 beds or 90 beds or 100 beds. So we brought in a different management team, a different company, and we have been on quite the tear. So we now own 11 of the buildings, which valued at over $250 million in commercial real estate. We actually manage 58 buildings across the two companies in Texas, Florida, and Georgia. Last year, we were an Inc. 5000 fastest growing, and this year we were an Inc. 500 fastest growing company. So we have scaled these companies up very quickly. And in terms of just assisted living memory care, we are now the 49th largest provider in the United States. So we keyed in on that. But getting back to, in terms of investing, what did we learn and why did we focus on this? Is beyond just the fact that these are actual buildings that we've built. We focus on that private pay, higher end, high amenity. And I got to tell you, I love these buildings because when you go visit a really high end, good assisted living memory care, it's like a cruise ship. It just never leaves the port. They're great places to visit. They feel good. They're fun to go. The people are having a good time. But in terms of investing, it's very unique in terms of investing, because what we learned in COVID certainly did not help us think well of, hey, let's go develop more movie theaters. But it did for this type of asset, because one of the things that you have to look at in any type of real estate is demand for your product. How many people want to move into your building or your home or your multifamily? Well, no matter what's going on in the economy, demand for assisted living memory care is somewhat agnostic. In other words, it really doesn't matter what's going on in the economy, because this is a time of life issue. Everybody on this call, no matter how long you live, if you live long enough, you're going to need some type of assistance at some points, whether that's home health in your home, whether it's memory care, whether it's assisted living, whether it's skilled nursing, whether it's hospice, something. It's just a fact of life. And so we looked at that and we said, that's great, because as we're looking at these assets, we're looking for something that's repeatable. Well, COVID created a very interesting, COVID created a very interesting opportunity here, because we had a good demand. And, at first we were a little scared of it because we thought the government might shut down assisted living memory care, but they just couldn't. Families couldn't afford to take the family back in. They just couldn't care for them. So they stayed open. But it also pushed the rates up quite a bit. And when we looked at the return of these type of assets compared to other assets, and we do look pretty much at everything, it showed the annualized returns. And something that we were experiencing is we kept seeing that every single year, these values of these buildings were going up. And primarily it's because of operations. When it's the value of assisted living is not valued necessarily by cap rate, times your NOI, because a lot of this stuff you're looking at, it's based more on the EBITDA number. So your earnings before interest, taxes, appreciation, and rent. So when you started looking at the EBITDA number, and we knew that we could control that because we were controlling the operations, we started looking at the returns. And this is kind of just shows how the black bar shows how senior housing compares to other different asset classes. And beyond industrial, they look pretty darn good. But I will tell you this, one of the things that we learned very quickly, again, is when we saw that multifamily, which we're big believers in, but multifamily, during the pandemic, you had, you couldn't evict people, you couldn't raise the rates, you had people skipping out on their rent, you had government assistance programs. I mean, it got to be very tough. We didn't experience that in assisted living. It's unfortunately, you have to be kind of rich to live there in the first place. But again, as an affluent type of customer, but look, the rates continue to increase year over year. And sometimes because your average tenant in assisted living is 24 months, your average tenant or resident in memory care is about 18 months. It's very easy to reset and raise those rates along the way as you need to when it comes to debt service. The magic of the seniors market is this: it goes down to demand. So in terms of the senior population in the United States, and you guys may have heard this before on other calls, there's what's always referred to as the silver tsunami. And all that really means is that you've got this very big bubble of aging population, the baby boomers, that are hitting. And if you can see this, you can see that, it's about 12% of the population in 2010, but by 2050, it's 20% of the population in the United States is the senior citizens over 65. Well, the good thing about the over 65 population, and I'm going to assume there's a lot of, over 55 on this call because we're talking about IRAs and significant dollars to invest, is that population has the greatest control of the greatest amount of wealth in the United States. It's kind of funny that marketers will always concentrate on millennials, which I don't understand why, because they don't have any money. So, it's this market that, that A, you have a growing demand for, but then B, they have the means to pay for services. So in this next slide, this is probably the best one to kind of go through. If you look on the left, it shows that 80 plus population. You can see it's that big hockey stick starting in year 2022, this hockey stick of growing seniors. Well, here's where COVID and now the interest rate crisis has really created a good opportunity. Senior housing had been fairly overbuilt by 2016, and so people stopped building. Well, but now during COVID, almost all construction stopped, and the construction prices, because of inflation now and supply chain issues, has remained extremely high. So as you can see, the net inventory is dropping, and it's dropping significantly. But the problem is the demand and the number of people who are demanding this type of asset is growing at exponentially. So you have this kind of weird divergent. You got demand going up, but supply going way down. Well, when that happens, what happens to price? Not rocket science, it just goes back up. And that's exactly what we're seeing, because we're now seeing these buildings that we're building or buying. We see these assets now, the multiple on these is going up significantly, and it creates a good opportunity for us. But I will say this: I think that right now, when I talk about a window or a kind of a time window, the time window on senior housing right now is this: it's going to correct. When interest rates are going to come down at some point, probably not for another couple of years. But when interest rates start to normalize, supply chains start to normalize, there's going to be somewhat of a building boom going in. Well, right now we have 11 properties. We love to own 20 properties. We want to be in that situation when people are building and there's a building boom going on for the senior assets. We want to have those newer contemporary style buildings that you don't have to build. You don't have to fill. Ours are built and they're already full. You have a great management company behind it, but you're going to have to pay a premium to get them. And our whole goal on this is to sell these as part of a larger portfolio. Now, we are opportunistic, so we talk to anybody with a checkbook who wants to come talk to us about a property to turn. We're not rigid enough to where if somebody throws a lot of money at us on a property that we won't turn it, because we certainly will, because again, the name of the company is Black Ink, so we are looking for profits. One thing I'll show you again, this kind of just goes to the point, and then I'm going to get to examples. If you look at the population in terms, just starting at the top there, the top four bars there, this is 60 and older. You can see the average wealth by age in terms of it. So again, I still don't understand why marketers spend so much time with millennials, because they don't have any money, but all the money resides in, the people in 60 or older in your hands. So, and in those hands, they're going to sit there and demand, good products on the other side. So here's lessons that we learned. The appreciation of these assets is directly related to operations. That's why we wanted to own operations. Right now, there's a lot of great REITs to invest in, and there's a lot of advantage to invest in REITs that specialize in this. The Ventas of the world, the Welltower, NHI, great partners to have. But you'll see if you read their annual reports, they're shuffling operators right now. They're looking at different ways to increase operations, and it's a people problem. We like to control that and try to take some of that as much as we can, minimize that risk by owning those operations. As we talked about before, the demand is agnostic. It's a time of life issue. The 60 and older demographic is the fastest growing demographic in the U.S. Incidentally, here's a fun little fact. 2024, the United States will sell more adult diapers than they will kids' diapers. So kind of a funny little thing there. The combination of the COVID pandemic, the inflation, high interest rates suppressed new construction for the last 3 years. We expect that to go on for a little while longer. The over 70 demographic has the greatest control of wealth in the United States. So if you're looking for people to invest in your product or your property, you might as well go where the money is. And then seniors are willing to pay a premium for upscale facilities. One of the things I like about our owned assets is we are very proud of these assets. It's when you walk in, the best thing I can ever hear if an investor goes into a building that we have bought or own is walk out and call me up and say, man, I would live there in a heartbeat. I'd move there today. That's exactly what we want to hear. And we do have a very good culture that takes care of people. We are very, very protective about that. We spend a lot of time hiring. We always tell people in this industry that if you're going to work in this industry, it's not a job, it's a calling. And we want people to have that calling. So types of investment opportunities. So I'm just going to give you examples of things that the way that we see these. There's two types of ways that we've structured investments, in specifically real estate investments in this. In the first way, the left side, convertible debt security. This is primarily for building ground up. So acquiring the land, building the building, filling it, and then getting it stabilized. When I say convertible debt security, here's what I'm talking about. There's kind of four factors that we look at when we go to build a building. A is there the demand for it, so we look at a big market study. B is it, can we build it in such a way it's affordable for that population? So we have to really know the demographics of the population. We are also, if you notice what I said earlier, is that we operate in Texas, Florida, and Georgia. That's by design. We do factor in the political risk or the government risk of where we build buildings. The pandemic, again, that taught us a lot. Texas, Florida, Georgia, very sensible governments. Things were able to open very quickly. It wasn't so onerous, but I know that for instance, multifamily. Even in Texas, if you get to Austin, sometimes they pass laws that are rules, I guess, the city council that can be negative to multifamily or something, where they don't want you to raise your rent a certain percentage more. They want rent type of controls or, eviction moratoriums that go on longer than they should and all that kind of good stuff. So we do really factor in the political or government risk. But then also, how do you get out of the investment? Real estate's great unless you're stuck in it forever. There's got to be an end and an exit. Well, this is where, again, senior housing is very unique, I think, in a lot of different ways. When we do an investment on a building, a ground up build, the investment is structured as a loan. It's a 60-month loan, 60-month or less. The reason that we structure it as a loan is there's two ways that you're going to get out of the investment and exit and take your profit. And that's either we sell the building, which in case we're all out of it, or we refinance the building. And refinancing in senior housing is extremely common because almost most of the properties are going to refi after they build and stabilize to either a HUD type of loan or a Fannie or Freddie type of loan. Because once you go to a HUD type of loan, you get these terms that commercial banks and commercial debt just cannot compete with. You get a lower fixed rate. You get a 35 to 42 year amortization. They becomes non-recourse paper and it's fully assumable. So it's very attractive loans, but it's a pain to get to. I mean, there's a whole industry of REITs that they want you to build the building, fill it, stabilize it, take it to HUD. And then, oh, by the way, now we'll pay you a premium for it because you did all the heavy lifting. So, but from an investor's point of view, when you're invested in that building, you are structured as a loan. And the reason why is because when you do the refinance with HUD, they will not let you take equity out of the building to pay your investors. However, they will let you retire and restructure all of your debt. So what we offer, if you look at the third thing, is the interest rate through the loan period, then you convert to equity. So we kind of give you the best of both worlds, kind of a hybrid type of investment. In the projects we've done before in the past, we will let you pick an interest rate of either 4, 6, or 8%. And to that, you have a corresponding piece of equity in each one of the buildings. So in other words, if you have an 8% interest rate that we're paying you, it's an annual interest rate we pay quarterly, you're going to have a smaller piece of equity on the end. But if you have a smaller piece of equity or smaller interest rate, you're going to have a larger piece of equity on the end. And the reason we do that is because, again, not everybody's going to have the same investment goals or investment strategy. So if you're looking for income, obviously you want a higher interest rate. If you're looking for higher upside, you're going to choose a smaller interest rate, or you can split somewhere in the middle. The investments that we look for, we structure every investment where it has a more than reasonable opportunity and expectation that your annualized return looking back is going to be 14% or greater a year. So I think a lot of investors that we have found have liked that it's structured as a loan because it protects the principal of the investment. So for instance, if you had invested, $500,000, we're paying you an 8% rate, and at 4 years we go to HUD, we refi it. Well, I've been paying you 8% on that $500,000. Now I give you your $500,000 back, and the day that we give it back to you, that building, HUD has given it a value. Let's just say it's $50 million or $25 million. Your equity piece is going to be worth X. We will let you either cash out that day, take your equity off the table, just you're out of the investment completely, or take your investment back, your principal, your interest rate stops, you convert to equity, now you stay in the building. So through the loan process, you're paid on a 1099 INT. It's just interest on a loan. Once you switch over and now you become equity in the building, you now get a K1, and you're in the building until we exit. Which realistically, I would tell you this, I can't see us owning these assets longer than another 3 to 5 years because of what I talked about earlier. So so just kind of a recap on the debt security side, it is structured as a loan, has a beginning and end date. You pick an interest rate, 4, 6, or 8%. It has a corresponding equity piece. When we did our first building in College Station, Texas, we did all of our pro formas and projected return on investments based on the lower of the numbers and we used the $26 million value. However, the building's worth $33 million. So the investment, which was projected at a 14% annualized return at a $33 million, is closer to a 20% annualized return. So works out good for them. So I wish I could tell you I would predicted that would happen, but I didn't. I just knew that 26 million would be an easier number to hit. On the second type of buildings that we do are buildings that we purchase. When we purchase them, we can lever those up pretty high, typically 80, sometimes even 90%. So we're not really requiring a lot of equity, but we do create opportunities. So what we do is, in case, let's say we're buying a building for $10 million and we need to bring 20% equity to the table. So Ernest and I will act as guarantor on the debt. We'll put down however much it is we put down, but let's assume that we need to have $2 million in equity. We will typically structure that in 24 months or less paper. It's not a loan. So we might take $2 million and we'll do what we'll call a share purchase agreement. So we will say, we'll sell you, we'll take the $2 million, we'll chop it into $100,000 shares, so 20 shares. So you buy a share for $100,000. That's going to be used as equity to purchase the deal. It's going to have an annual preferred return. Because it's a short-term debt, it's typically going to be a higher return. So if your goal is just cash flow, that's a pretty good investment for you because it's probably going to be 10 to 12% is your annual preferred return, and we do pay that quarterly. But the shares are callable at the par value. So in other words, those 20 shares at 100,000 each at any time in that process, typically when we go to refinance with HUD, which is what the goal will probably be, or Fannie and Freddie, we're going to call those shares back. In other words, buy them back for the par value, 100,000 each. So all that happens is your interest rate just stops, or sorry, your preferred return stops. So you get your money back, and if you're getting paid 12% a year, 2 years, you got your 24%, and you get your money back, and that stops. And it is a preferred return, so you're paid before we are. So that's kind of two different examples of, kind of the ways that we look at this. In terms of, senior housing I think there's lots of opportunities out there. I will tell you the key things that you really need to key in on is size does matter. I know that there are several investments available with smaller size memory care units, assisted living, group houses. And I'm not saying that those are bad assets. They're not. However, they are very difficult unless you have a very high demand to stay full all the time. And really, if you have a 20 bed unit, if you lose 2 or 3 residents in that month, you're going to go negative very quickly. So it's kind of hard to stay on the positive side, but not impossible, but hard. But I would take a very key look. Also, you want to make sure that your asset for real estate is completely separate, its own entity, because there's lots of liability in senior care, senior housing. So you want to make sure that that is on the operator's side and the tenant side and not your side. You want to protect yourself from that. And then I would also tell you to really watch, make sure that you have a good operator who's been around for a long time. You certainly want to study that. And then also you want to look at really where you are, because I'm not sure if there's ever going to be another pandemic again, but you want to know that you kind of look at how they dealt with it in the past. Talk to the company that you're partnering with and figure out, just go back and look at their numbers. How did they navigate through that system? We saw it as creating a good opportunity, and I think that's the case it is right now. But going forward, you really want to watch who you're with. So I always say that in this type of investment, it feels good to do good. That was kind of one of our investors told that to me. I always encourage investors when they invest in a building to join their Facebook page, to see the people, the residents or the patients enjoying the asset that they're invested in. And he said he just really gets a big kick out of seeing the different things that we do at assisted living. And some of those, deal, again, it's like a cruise ship that never leaves. He said, I just love that investment because I feel like my money is doing something good for people. When you go visit, it's just a happy place to visit. So here's my contact information. Feel free to email, call me. If you go to blackinkus.com, you can see the pictures of different projects that we've done all throughout it. So Dallas Senior is our assisted living, Carity Healthcare is our skilled nursing business. So let's see how much time I burned through there. So a little quicker than expected, but I don't really typically do these a lot. So be happy to take some questions. Well, I don't know if somebody's talking because I don't know. Oh, there she is.
Yes, hi there. All right, so we do have a couple questions. The first one is regarding your exit strategy. Does your exit strategy include selling all of the businesses or just the senior living facilities?
Well, ultimately all of them. However, I always say everything's for sale. We're opportunistic. I mean, if somebody wants to come in and make us an offer on one building specifically, that just fits into their, yeah, certainly we'll consider every single offer that comes across the table.
And from the same viewer, how does the Alamo Theater feed into the operations of the living?
It doesn't. Totally separate investment. The idea with that asset class is that we were going to build a portfolio of those and sell them as a portfolio. But now that we own both operations and the movie theaters, we still will sell the assets. Now is not the right time to sell those. Probably another 2 years to cure before we sell those. So it was just diversification. That's the only reason that we ended into this. But what we learned through the pandemic is why we have focused almost entirely now on senior housing, just because we think right now we're being opportunistic and it's a unique opportunity for timing.
And one of the last questions I see that we currently have in the chat, what is the minimum amount to invest?
Yeah, good question. So when we do development ground up, it's typically 250,000. But when we do acquisition, it's 100.
And then we actually have one more pop up. Oh, my apologies. When you sell the facility, does the complementary business offer services to the new owners?
Yeah. So again, sometimes if it's bought by a REIT, they're happy just to keep the current management in place. But if it's bought by another healthcare company, they want to replace both sides. They want to buy the business as well as the facility. So it's kind of it just depends on the buyer.
Gotcha. And I know you may have touched on this during the presentation, but for these types of investments, do you have a lot of IRA investors who typically partake in these offerings that you have?
Well, good question. Not necessarily particularly. This is somewhat a little bit new to us. As a matter of fact, we don't have a massive investment group. In the last few years, we somewhere between 40 and 50 million in private equity, but a lot of our average investors have more than $1 million invested. So it's not a huge group. But when I sent this out actually to the group, I was surprised at how many of them had already seen it through Quest. So probably more than I realize, but I don't know.
Great. And do you find any particular benefits for those that you know of who are investing through the IRA? I mean, outside of what we know to be the tax savings that you're going to get, just not having to pay those taxes right on the front end, but potentially deferring them until retirement. Any particular benefits on that end?
Well, I think the benefit probably is just because, it's just knowing what your return is going to be, because it's a little more it's more of a predictable return in terms of the cash flow if you're, from the interest or the preferred return. But then when it goes to the upside is having that option of either at the point of refinance, taking it off the table right then, or saying, no, actually for my timing right now, that would be terrible. I'd rather wait until you guys sell it as part of a portfolio.
I would certainly agree with you there. I think there's a couple things throughout the presentation that you touched on, that when we talk about moving over from stocks, bonds, mutual funds, and then parking it into alternative investing, that we really find some benefits. And one of them that's not as common, but we like to talk about in our basics presentation, is what we call social investing, which is what you said, where you can park your money into something that's doing good for the community, right? And you're not just, putting it into an investment hoping to make money off of it, but there's now this additional layer where you have, a personal touch, and you're able to really see a difference that you could potentially make to the community. So that's always great to see in any asset class. I'm glad you were able to touch on that. And then the other one, like you mentioned, being control, having a lot of control over when you do exit that, whether you want to continue, keep that equity in the property, or if you just want to get the cash out now, just depending on when you're planning to retire and things of that nature.
Well, and just to add to that, a lot of times the opportunity is going to be that when you have the opportunity to invest, is you are going to invest in a building that might be struggling. I mean, there's your opportunity is to get that uplift and create it. But one thing that this probably just from experience is that you really want to look at, when you buy a building, there is going to be an existing management in place. And you need to see how sticky that contract is if you need to replace them, because sometimes those projects or those contracts are very sticky. And if you've got to pay them 5 years management fees just to get rid of a bad operator or a bad manager, that can be owners that can kill the deal. So you really need to. That's one extra thing that you need to ask and talk about.
And while we've been kind of chatting here, we've had a few other questions come up. Not sure I understand that, but you may be able to pull something from this.
Yeah, it's a good question. He's asking, would you sell the operations and the building separately? Gotcha. I would sell the building while owning operations. I would never sell operations I would never sell the operations and keep the building. You're going to give up too much control. We have actually had a few really good offers to buy just the operating side of our business. But because our investors are on the real estate side, we feel like we're going to give that control in terms of our ultimate exit. So we're not going to sell operations before we sell the buildings.
Here's another
But we would sell the buildings separately, but not before.
Gotcha.
No, we don't own the Alamo Draft Houses in Austin. Those are all corporate owned. And we work with two different franchise groups, And so we do not own those in Austin. Know those guys really well. Alamo Draft House, still own part of Alamo Draft House franchisee. Great group. I like Alamo, big fan of it. I will tell you, the only reason that we became our own brand in Arizona is just that market changed so much that the franchise model we felt needed to be adjusted for the benefit of the franchisee. Alamo had gone through a structured bankruptcy. They just didn't want to change those, and we had an opportunity. It was a very easy separation, mutual. It wasn't a contentious one, and I think there's a good opportunity they could buy us back at some point. Who knows? We operate everything internally. So the question was, do we operate? I hope everybody can see that. Mm-hmm. Do you operate the properties internally or use a third party? No, we operate them all internally.
And from Mr. Hull again, how and when does the investor benefit from depreciation and tax benefit if starting as a lender, but ultimately getting that equity?
Yeah, good question. So you're not gonna be that quote unquote get the depreciation tax benefit until you get to the equity portion. Yeah. So because operations have such an effect on the value of the real estate, we will not sell the operating company before we sell the buildings, but we would sell the buildings before we sold the operating company. The idea is to sell them all together. However, hopefully that answers the question.
Well, we'll give some time here in the next minute or so for any additional questions to trickle in, but I do want to thank you for taking the time out of your Saturday and sharing this information with us. A lot of really great strategies and information for people. Apologies.
We've gone to the dogs already. There you go.
And so a lot of great information for those investors who are tuning in today. Any closing words on your side? Anything that you would want to say just to kind of wrap us out today? This will be posted online as well, just so everyone's aware, to our YouTube page to rewatch it. So for anyone who may be trickling in after the fact, any wisdoms you could share?
I will tell you that, again, I'll really stress that if you talk to anybody who's really related to or some of my finances, this type of asset, or is very active in this type of asset, I think they would all parrot and tell you the exact same thing, that there is a somewhat unique opportunity in the next 3 to 5 years that there should be a large building boom of new assets just because of that demographic of that senior tsunami coming into it. They're going to have to. And I also think that, the United States government, one of the things that politicians love to do is they like to look at those demographics. That's one of the reasons they talk about Social Security so much in elections. I think there are going to be more benefits coming towards seniors down the road in terms of housing. Our projects are private pay. They're higher end, all private pay. We don't really deal with insurance and that kind of stuff. We do in the skilled nursing business. But that's a whole different type of animal. But in the assisted living memory care, it's all private pay. And, you got to just watch your market, just kind of like mini storage. If you go into a market that's overdeveloped, you can have the best product in the world, but because of competition, you're not going to fill it up. So.
Yeah, really great closing statement. And one more question came in. Would you consider investors with less than $100,000?
On a case-by-case basis, probably.
Are you open to non-accredited investors, or is the offerings typically for accredited? Okay.
No, it's just accredited.
Yeah. We've got a few kudos in here. Everyone thanking you.
Thank you.
Coming out today. Great presentation. Like I said, this is going to be archived through our YouTube page. So for anyone who may be coming in a little bit later, or if you want to revisit the slide deck, Mr. Stallard's contact information will also be included there. So feel free to reach out. You have been able to, shed a little bit of light on this asset class. So we really want to say thank you for that.
One thing I'll add too, there's a really good book about this asset class. I didn't write it, so I don't get anything for this, but it's called The Longevity Economy. And it's written by a guy, Dr. Joseph Coughlin, and he is the director of the Center for Aging, I believe is what, no, the Age Lab at MIT. And he's a fascinating guy. You can find him on YouTube, but he will really give you some pretty good insight. I saw him at a conference, great speaker. But he really gives you good insight into marketing and what seniors are really going to spend their money on and where they're going to spend it. And so again, this isn't about investing. So it's looking for investments that there's demand, affordability, and return options and return opportunities. So I think this is a good one. But that's a good book to read.
Well, I think that with that being said, we are about all wrapped up.
Cool.
We appreciate you. And I think that if there are no more questions, we're going to go ahead and close out the stream today. We will be here next Tuesday as well as next Saturday with more information on alternative. For those of you who would like to see a little bit about that, please do. Mr. Stallard, someone is asking again for your contact information. Would you mind just repeating
Sure.
that? That way they can take it down real quick.
Yep.
Perfect. Or we can add your, yeah, there we go. That works.
Oh. There we go.
All right, here it is for you, for Guy. That would be the contact information there to reach out to Mr. Stallard and get some more information on how you can get started in this asset class. But we will go ahead and close out. And we thank everyone for taking the time out of your Saturday to join us. And we hope that we will see you at the next one.
Thank you.
Thanks, everyone.